Hey, what's going on guys? Welcome back to Kiwoon. I'm Caleb, and today we'll be going over the secret that no one ever told you about the stock market. Growing up, I always thought of the S&P 500 to be one of the best technological and high growth indexes out there. But what if I told you that Nasdaq has not only outperformed the S&P in the last year, but has also outgrown them by a factor of 2 and tripled the value of Dow since 2002. And since it's the new year, I wanted to cover the past 20 years of these 3 major US indexes and how they are set up. This is officially our 50th video, and if you guys are enjoying the content, make sure to hit that like and subscribe button down below. Now let's get right into it. So, to begin with, what is the difference between these 3 major indexes? The Nasdaq and the S&P 500 cover more sectors and more stocks in their portfolio, while the Dow is a more blue chip index for 30 specific stocks. The Nasdaq and S&P assign weightings based on market cap, while Dow assigns weightings or percentage of stock based on the total price. Investors cannot directly trade these indexes because they are representations of the performance of a grouping of stocks in a form of an average. However, there are ETFs that people can buy that can represent the index's movement. To start off, we have the Nasdaq Composite. The Nasdaq performance reflects that of the exchange, which in turn is indicative of the performance of the tech sector. Currently, the Nasdaq is more than 3,000 stocks in the index and roughly 2,500 within the actual composite. Currently, there have top 10 companies of the index with tech giants like Apple, Microsoft, and Amazon that make up over 44% of the total index. And then we got the Dow Jones. The one that a lot of people know as just the heavy hitter, one of the biggest indexes in the entire world. So, the Dow, as of December 2021, covered 9 different sectors ranging from information technology to energy and financials. In contrast, the Nasdaq Composite and S&P 500 attempts to cover many companies in different sectors, while the Dow is really specific to these 30 companies. The Dow's selective makeup means that it is not always accurate gauge in the stock market's performance or of the US economy. It holds 30 stocks of some of the biggest names. As of right now, there are companies like Intel, Walgreens, and Apple, but some people tend to get confused when they see Apple in both Nasdaq and Dow. But all this really means is that it's just a small percentage of the overall index, and Apple is just, by any technical mean, a small piece of the pie for these major indexes. And then lastly, we got the S&P 500. To even be included, these companies need to have a market cap of at least 11.8 billion. And for example, we see companies like Apple in the S&P 500, and because it has the largest market cap, or it has the largest weight, meaning percentage of the overall index. As we can see here, the weight is 6.8 or 6.8% of the entire index, with a market cap, I believe, of just over 3 trillion. And so what's really interesting about the S&P 500 is that not only do they need a market cap of at least 11.8 billion, but they also need to have public ownership of at least 10% of its shares and a positive earnings of the most recent and the last 4 quarters to even qualify to be in the S&P 500. Now we know that the basics of how these indexes are set up and kind of how they're made. How has the Nasdaq even outperformed the others? And so this is where we go down to the industry breakdown. And as we can see from this chart, Nasdaq has nearly double the amount of the weight in technology than the S&P has. After the dot-com boom and fall of the 2000, tech has exponentially risen. Although the S&P 500 has more healthcare, gas, and financial sectors, it almost just doesn't even compare to the exponential growth of the tech sector within the last 2 decades. So what does this all mean? Basically, we're just trying to understand, as an investor, your risk tolerance and the companies you want to be investing in. And it's extremely important to look at these different indexes so that you can understand what they are comprised of. The Nasdaq is extremely technologically focused as well as consumer services. The Dow is mainly focused on biggest names in the market, while the S&P follows the overall economy of the US, and it is a lot more evenly distributed than some of the other indexes. I would say that if you believe in tech, try finding ETFs that are based around Nasdaq. If you are looking into more volatile with maybe more implied losses, then you could go into the Dow. But there could also be a lot more implied gains. The Dow also has very trusty and has been one of the best performing indexes even if the market decides to go sideways. And as I was saying before, companies like special considerations, we can see here that all these are just indexes and you need to have actual ETFs to actually be able to invest in them. So we did a video even on VTI, for example, which is Vanguard's one of their total index funds, which actually covers 3,000 different stocks that you can actually invest in. And so while VTI is extremely good, I really do think that the overall S&P 500 will outperform compared to other two indexes within the next 5 to 10 years, even though Nasdaq has outperformed for the last 2 decades. The reason for this is that I still believe in technology, and S&P definitely still has a lot of technology in it, but I do think there's going to be a little more in terms of industrial and cyclical stocks coming in soon. Again, you need to create your own convictions, and the main point of this video was to talk about historical performance and how the indexes are even set up and what are they kind of comprised of. But yeah, guys, that's basically all I have, and I know this is more of a more informative vid, but I hope you guys have a great rest of your day, and make sure to leave any comments down below about these major indexes, and peace.